Valley Bank collapse, the Signature Bank collapse, the First Republic Bank collapse, and sort of the responses from the Fed in the wake of that banking crisis. And I know this video is a little bit overdue, but a lot of stuff has been going on. But, I tend to want to avoid jumping to conclusions when major things are happening. I really want to sit back and digest them, kind of put all the pieces together. And I do think that the pieces are sort of in place to kind of examine what has happened from a first principles perspective. So before we get to the solution, I need to start with the problem. And there are internal problems and external problems. I'll start with the internal problems. During the pandemic, reserve requirements were set to 0. Now, what does that mean? That means that when you give your money to a bank, when you deposit money into a bank, they take that money and generally lend 100% of that money out, primarily in the form of mortgages, mortgage-backed securities, and government securities, government debt, buying U.S. treasuries. Now, the reserve requirements were set to 0 during the pandemic, and they still remain at 0, even though the pandemic's over. Banks effectively lent 100% of all customers' deposits to primarily the government and home buyers. So, what's really dramatic about this is that money is not there, right? I mean, you think that your money's there in your bank account because you have a number on the screen, but it's not there. It's been lent out to other parties. They have it. They owe your bank that money, but they don't, there is a scenario where that they never repay it. Now, not only did interest rates rise, but interest rates rose at the fastest rate in history, and a lot of the values of these loans have declined over 50%. And it makes sense. If you have a treasury bond book, particularly with longer dated maturities, yielding 2%, say a 10-year treasury bought during the pandemic, yielding 2%, and now I can go onto the market and buy a 10-year treasury for double that, why would I buy your treasury bond that yields 2%? Well, I wouldn't, because it's not worth as much. So the banks have loan portfolios that aren't marked to market, because if they marked it to market, the value would be unbelievably low. They would be insolvent. And not only is the mark-to-market value lower, but the execution price, if they were to actually go into the market and execute a substantial amount of their holdings, would be far lower than their mark-to-market price. So, long way of saying that the value of these loans that were issued during the pandemic prior to the parabolic interest rate hikes are effectively 0. Now, they have a yield, and they have borrowers that have promised to pay. Essentially, the U.S. government, in the terms of treasury bonds, have promised to pay the original principal paid for the treasury at the end of the term, at maturity. And the government is actually pretty good at doing that, but that promise doesn't solve the liquidity issue between the date of issuance and the maturity. And then you have mortgages, which are promised to pay from a homeowner, which, may or may not come to pass. Now, of course, debt instruments with the longest maturities have the most duration interest rate risk. Now, essentially what's really important here to realize is that the banks went bust and went insolvent from betting on long-dated treasury maturities. Effectively, what happened was they went broke betting on the long-term financial health of the government, which is quite ironic given the circumstances. Now, banks are insolvent. They can't honor withdrawals, right? Like we mentioned, reserve requirements are at 0%. 100% of deposits were lent out to other parties. Now the value of those loans is effectively zero. They can't be liquidated for cash, and there is no money, there's no liquidity to pay depositors. The banks are insolvent, or were insolvent, prior to the Fed's response. Now, the Fed stepped in and created the Bank Term Funding Program, which essentially means that they will accept Treasury securities as collateral. And in the process of doing that, they will honor the value of the collateral at par, which means at the value, the original principal that it was purchased for, prior to the 50%, 60%, 70% losses. And in return for that pledged collateral, they'll issue credit at the 1-year fixed swap rate, which is roughly 4.5%. So essentially, the banks now have unlimited credit from the Fed, which is newly issued currency, at the 4.5% interest rate. But that's not what's important. What's important is that they didn't have the money to honor withdrawals until the Fed started printing money. So whenever anybody goes to withdraw money from the Fed, from their bank, the Fed is essentially mediating that exchange by stepping in, issuing new currency to meet those withdrawals. So in a way, people are withdrawing their, because remember, the money that they deposited is no longer there. It's lent out. It's gone. When they go to withdraw, they are withdrawing newly issued currency from the Fed, from this new program, in a two-step fashion where the banks are effectively the middleman between the currency issuer and the withdrawal. I think that's really important because I don't think people appreciate the magnitude of the currency debasement that's going on. And, one of the insidious, parts of that is that currency debasement doesn't necessarily reflect in higher prices right away. Higher prices, for whatever reason, tend to take 6 to 9 months to manifest. So we have extreme debasement going on, and probably will continue for some time. Remember, deposit outflows in the banks correlate directly with the amount of money printed. So the longer these bank runs continue, the more currency the Fed will have to print to meet those withdrawals. And it wasn't just Silicon Valley Bank, week one where you had the bank run. No, this has been an ongoing thing, week after week after week after week, even at this week, right? It's been a couple weeks now. And there's no sign of it ending. So, the printing will continue until morale improves. No, the Fed will print money as long as there are more bank runs. The newly issued money, the currency debasement, scales directly with the amount of funds withdrawn from the U.S. banking system. And that's a fundamental problem. There's no way around that. There's no way to deal with that. It just is what it is. Now, this meme right here is pretty good. Maybe you're insured, maybe you're not. In the Silicon Valley Bank collapse, we saw all depositors made whole, right? Rather than just the 250,000 threshold that is usually the FDIC threshold. They went above that and insured all depositors, 100%. But that's not official law, so people don't really, it's a very gray area, right? It's like, maybe you're insured, maybe you're not. And it sort of begs the question of what is the upside in holding cash in the banking system? Why would anybody do it? What is the upside? There's significant risks that weren't appreciated that are now being appreciated at scale, but there's no upside. So from a risk-reward perspective, it just doesn't make sense. A lot of people in Silicon Valley Bank over the weekend, that it happened, a lot of those guys were rich tech guys in Silicon Valley, and they may have had accounts at Silicon Valley Bank for like 15 million, way, 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 way above the FDIC threshold. So they spent the whole weekend thinking that they just lost their ass, right? That they were just out $14.75 million above the threshold. That's a real, lesson in counterparty risk. I mean, talk about learning the hard way, right? Now, ultimately, they were all bailed out, but, trust me, it was a long weekend for those guys. And, people, it's one of those things where people can intellectually understand the concept of counterparty risk, but they kind of have to experience it to really embrace it on a fundamental level, to the point where it starts to impact their behavior and they start to consider it as a legitimate possibility. And unfortunately, the only way a lot of people learn it through that is through pain or through close encounter with significant loss. So another question is like, well, okay, if counterparty risk is the issue, why would we invest in banks? Well, people are asking themselves that, not invest, but hold our cash in banks. A lot of people are asking that question, and it's resulting in, hundreds of billions of dollars being withdrawn from the U.S. banking system week after week after week. Despite government officials saying everything is fine, there's nothing to see here, go on with your day, citizen. It's not okay. It's a major systemic issue that is still ongoing and being swept under the rug. Because there are alternatives, right? There's no reason for people to embrace counterparty risk by putting their money at a bank. There's just no reason to do that when there are alternatives, right? There are bearer assets like Bitcoin, like gold, like real estate that exist outside of the banking system, where, if you have Bitcoin, gold, and real estate, and commodities too, I shouldn't leave commodities out of there, but physical goods, if you have those, doesn't matter what happens in the banking system, right? The entire banking system could collapse. You have real tangible assets that are outside of those systems. And so what you're seeing here is you're seeing capital flight. And that's a real problem, because the debt markets are one big Ponzi scheme, right? It requires more and more growth, more and more investments, more and more debt issued. If you deflate it, the whole thing collapses. And you have to keep it going. You have to keep inflows up. So whether that's organic inflows through organic demand, or synthetic inflows from newly issued currency, monetized debt, one or the other. I mean, we would, of course, everyone, including the government officials, would prefer organic demand. But if they have to create it synthetically, that's what they're going to have to do. I mean, there's no way around it. You have essentially, what the Fed has essentially done with their new program is they've essentially guaranteed that Treasury bonds cannot generate a nominal loss. Now, that's really significant because, it doesn't really matter if you're comparing nominal losses to real losses. And when I say that, I mean a nominal gain compared to a real gain. A nominal gain is the 5% yield you have on a 6-month Treasury bill, right? The government, say you invest $1,000 into a 6-month Treasury bill, yielding 5%. The government has promised to repay you original principal after 6 months, as well as the yield during the term of the bond. So you will generate a nominal return if you hold to maturity. You will make a nominal return, but you will also make a real loss in real terms because the inflation rate is much higher than reported. It's much higher than 5%. And if the government ever allowed real bond yields to drift above the real rate of inflation, they would go insolvent. Part of the whole operation relies on them being able to keep real yields negative, meaning that, yields on bonds, especially the short end of the curve, are at like 5% now. But you'll never see the rate of inflation dip below that yield. Because if that were to happen, and bond investors were able to make real returns that beat the rate of inflation, well, then the government would go insolvent. I mean, in that scenario, you have a borrower and a lender. One party is the party lending to the government. The government is the borrower who's, taking on debt. Two parties taking directly opposite sides of the trade, directly opposite incentives and interests, but only one party has the ability to manipulate the system. So, of course, the party that is able to manipulate that system manipulates it in their favor. And the way they do that is by ensuring that real bond returns are always negative. So they always win. I think that's, it's a very nuanced distinction, but it's very important because once you can understand that, the difference between nominal returns, real returns, that's like a very quick way to sort of get in the middle of all of the kind of distractions and red herrings that people throw up. And if you're able to think in those terms, you can kind of bypass a lot of the obstacles that get in the way of a lot of people's ideas. So kind of moving on from the internal problem to the external problem facing the Treasury market, you've got essentially you have a shift in U.S. Treasuries as a pristine collateral to a high-risk asset. So at the start of the Russian-Ukraine war, the U.S. government seized Treasury bonds from another central bank. The result, and that being the Russian central bank at the start of the Ukraine war. The result is that all other central banks who are not direct allies with America have become net sellers of U.S. Treasuries. The U.S. Treasury demonstrated their capacity to seize assets within the banking system that they control. If the U.S. government can't raise the debt to fund their operations due to lack of willing lenders, they will seize the capital in the Western banking system to meet their operational shortfalls. A larger percent of global trade is being settled in currencies other than the dollar. The fundamental value of the dollar came from the fact that it was a settlement layer for global trade. So the more of global trade that is settled outside of the dollar-based system, the less value of the dollar, less purchasing power of the dollar, and less value of the underlying collateral, which is the U.S. Treasury, which is bad news for the U.S. Treasury market because it's a Ponzi scheme. It's propped up on exponential growth, which means that demand needs to be exponential as well. Well, if organic demand is drying up, it's got to come somewhere, right? It's got to come, in this case, it's coming domestically from the banks, right? And the Fed is effectively monetizing 100% of the debt on the U.S. bank's balance sheet in the form of Treasury bonds on the U.S. bank's balance sheet, and effectively monetizing 100% of it at no limit. And that's the world we live in. I think, the currency debasement that's going on right now is very, very severe. I don't think people grasp it. And I think part of the reason why people don't grasp it is it doesn't immediately, result in higher prices. For whatever reason, prices take 6 to 9 months to, sort of start trending upward. But that would kind of put us around, sort of 2004 being a point in time where you start to see inflation start to pick up again, start to create new highs in a way that reflects the current debasement. Now, we don't know to what extent the currency debasement will continue, because we don't know to what extent capital will flee the Western banking system. All we know is that it's steadily marching out. Week after week, now it's been a month, maybe it's month after month, but it's been a steady march week after week, despite all the contraindications from the government saying that it's not happening. It is happening. It is currently happening. And the amount of capital that leaves the Western banking system is directly correlated with the amount of money that will need to be created, newly issued currency, to prop up the Western debt markets. Anyway, I hope you guys liked this video. I know I haven't really uploaded much in a while. Start to upload more, including price action concepts. So stay tuned for that. If you guys haven't subscribed already, please make sure to do that. I try to upload a